is Jennifer Schaus, and we're coming to you live today from Washington, D.C. Thanks for joining us in a sponsored content webinar brought to you by ELINT Capital. Today's topic is financial infrastructure for federal contractors or federal contracts. And we're going to start with Charlie Newmark, who is the founder of ELINT Capital. Charlie, over to you.
Thank you, Jennifer. Thank you, everyone, for being here. I'm Charlie Race Newmark, founder and CEO of ELINT Capital. And before we dive in, I thought it'd be a little helpful to share how we got here and how ELINT was born. When I was growing up, my father owned a small auto parts store in Orange, New Jersey. And like a lot of small business owners, he extended credit to mechanics in the neighborhood in the form of house accounts. People needed spark plugs or oil to keep their businesses running. Often those accounts, this is the early 80s, so a lot of those accounts were based on trust and relationships, but they created a constant cash flow crunch for my family, mainly my father. And I remember those conversations at the kitchen table, and they stayed with me my whole life. And later in life, because of those conversations and struggles, I became somewhat fascinated in trade credit and why these small business owners are extending credit to people that they can't afford to extend credit to, but yet the bank was trying to get more people to borrow money. So there was something backwards there. And I learned, obviously, that the bank never lends money to people that need it. They only lend people to money that don't need it. That led me to trying to build a system for mechanics, plumbers, electricians, contractors, to solve this cash flow problem. What I learned quickly is that no funder or finance partner wanted to finance unsecured debt. So that was a huge challenge in the beginning days, and I couldn't figure out how to get money to these companies, these small businesses that needed it. Then I learned about government contracting and that they represented one of the strongest assets available, the receivable from the government. And I learned that the government always pays, they just pay very slowly. Most of you probably know that. So that insight became the foundation for ELINT Capital. I then assembled an exceptional team that are on this call now. Includes, former government contracting officers, SBA leaders, banking and government contract professionals, technology experts. And while I am definitively not an expert in government contracting, I've been learning over the last few years working beside some of these people and creating this platform that solves one of the biggest challenges that contractors face. So ELINT is more than a financing company. I think that's important to say at the outset. We've built a technology and continue to build a technology platform that helps government contractors win more contracts, execute the contracts more effectively, and maintain a compliance as well. And also having access to capital, which was the initial seed that started this thing. A huge part of our offering is our partnership with Excalibur Capital, who we have a representative from on the call today also from there, because our vision wasn't just to create software or to provide financing, it was to connect the technology, the intelligence, the capital all into a single ecosystem for government contractors. So through our partnership with Excalibur, we're currently able to provide funding on contracts up to $20 million each. And unlike traditional lending, our approach focuses primarily on the strength of the awarded contract and the contract backlog, rather than your personal credit score or your balance sheet. So we're actually underwriting that contract in essence. That allows smaller contractors, like the ones my father was helping, to compete for larger opportunities, scale their businesses, and focus on execution without worrying about whether they have enough capital to bridge the gap between performance and the slow government payment. Ultimately, that's why we're here. So, I want to just say before I turn it over to Josh, that our mission is pretty simple, right? It's help government contractors grow by removing all barriers, including and especially cash flow. So again, thank you all for being here. And I'm going to let Josh, who built our platform, introduce himself.
Thanks, Charlie. Hey, everybody, I'm Josh Leffler, Chief Product and Technology Officer at ELINT. I've been in and around government contracting, the nexus really of where government contracting, financing, technology all meet for over the last 15 years. I come here most recently from having worked at Bloomberg, with experience at Live Oak Bank, PricewaterhouseCoopers, as well as the SBA, the National Economic Council, and others. Eric, do you want to introduce yourself?
Thanks, Josh. Hey, good afternoon, everyone. I'm Eric Rabinovich. I'm Managing Director at Excalibur GovCon Capital and head of the GovCon vertical. So we are the capital partner along with ELINT, and together we're very excited to share with you today the product that we're building, the service that we're offering. By way of background, I'm a former contracting officer. I spent time at the Food and Drug Administration, and Josh and I actually worked together prior to that when I worked as a contractor with PricewaterhouseCoopers in their public sector practice before they spun off into what is now known as Guidehouse. We've been on both sides of the table, so we have a lot of experience and understanding with what government contractors go through, the challenges they face, and particularly the constraints and the implications of those constraints tied to capital and access to capital. So we're going to get into some of that today, but we're happy to be here, happy to get into it. Jennifer, back to you.
Great. Thanks, Charlie, Josh, and Eric. It's great to have you guys with us. Let's just go ahead and dig in. So most of the contractors in this audience win contracts and then wait sometimes 60, 90, even 120 days for payment. It's a pretty long time. So walk us through what the actual, what the company does operationally.
Well, I can take this one. So here's the challenge. So of course the revenue is real. You won a contract, the contract is real, the revenue, the receivables are there, the obligation for the government to pay, that is all real. But the cash, it doesn't show up for months, sometimes weeks, sometimes months. And then meanwhile, you have to usually run payroll every couple of weeks. For some companies, it's maybe monthly. Subcontractors have to get paid. Overhead doesn't pause. And so I think what a lot of folks don't necessarily appreciate is winning the contract is when the cash crunch actually starts. And so it doesn't end when you win a contract. You're now staffing up, you're performing, you're billing. I think a lot of traditional lenders, they look backwards. And I think that's the challenge. A bank might look backwards and say, okay, you did well last year or last quarter, but if you just want a contract and you have to ramp up and start making those payables before you start getting those payments from the government, that's where you start running into issues. And operationally, that of course can create a lot of challenges. So that's really to Charlie's point, that's the challenge we're trying to address here. That's where we're focusing on. And so we are forward looking. And I think I would also add that, you know, contractors, those that stall or who lose contracts mid-performance, it rarely is a performance problem. It's usually a cash flow issue that then turns into a performance problem, and they can just run out of runway. We've seen it happen. So that, again, that's really the challenge we're trying to address here and to solve.
Great.
Yeah, and can I add to that real quick? Eric, I think that's extremely well said. And I want to tack on to that. That's why, based on our experience having worked on all sides of this, and having ongoing conversations with government contractors, it's why we put this product together. So our financing takes your entire contract backlog, because we know that if you wake up and breathe and do your job, that the government is going to pay. As Charlie said, the government always pays, they just don't pay quickly. We get it. Whereas typically financing will come in the form of especially credit lines, an asset-based line of credit, where that derives a borrowing base and your financing capacity from your receivables. Unless that doesn't help you, unless you already have receivables that are in process, that are already aging, but not too aged, and that aren't aren't crossed out by any ineligible others. So we take into account your entire contract backlog based on what contracts have been awarded, because we know it's your livelihood. And what happens if you don't do what's in those contracts? Well, you'll get hit with a negative CPARS. We know how problematic that can be, and it's why we have faith in our customers where they're looking to grow. We designed our product to help them do that.
Great. And contractors often think that they have a revenue problem when they actually have a cash flow problem. What is the difference?
Well, I'm not an accountant, so take this with a grain of salt, but revenue shows up on your income statement. That doesn't necessarily mean it's showing up in your bank account. And this is tying into what I was saying in the first question. Revenue isn't the same as cash, right? So you can have a revenue problem, and usually that's a sales problem, right? If you don't have enough revenue, you obviously need to look at ways to grow the business, manage the pipeline, and grow your customer base. A cash problem is entirely different. You could have a wonderful revenue position, a ton of booked contracts, but a woeful cash position where it's taking forever to get paid. You're struggling to keep your payables current, whether that's your employees, your subs, your vendors, et cetera. So, cash is what, of course, shows up in the bank account. They're not the same thing. And for a lot of contractors, they're not even close to being the same thing in this market where you can have massive delays and just a mismatch in the timing of when you win the contract versus when you start getting paid on those receivables. Obviously, it depends on the specifics of the contract and the milestone schedule and the contract type and all of those things. But that's really the fundamental difference. And the fixes for both are completely different, right? One is you have to drive sales and focus on how you're going to market if you're trying to address the revenue piece. The cash cycle is an entirely different problem with a whole different toolkit you need to look at if you're trying to address that. And I think conflating those two, as we've seen firsthand, it can be very expensive.
Okay. And why hasn't traditional banking solved this? Contractors have government contracts, and that's about as creditworthy as it gets. Why won't a bank just lend against that?
So it's a good question. I think in some respects, banks will lend to government contractors. I don't think that's in question. But the way that they underwrite a particular request for capital, and particularly for government contractors, they really try to underwrite the borrower more than the contract. So they want 3 years of tax returns, clean financials, right? They want predictable cash flow and traditional collateral in a lot of cases. Not every lender, particularly when you're looking at, say, an SBA lending situation, right? They're okay with lending against cash flow, instead of against strictly just collateral. And of course, if a lot of small business contractors in this market are doing professional services where there's not a lot of collateral, that's a good option to have. But even then, to my point, they're looking backwards. They want those last 3 years of tax returns. And so that if you meet those hurdles, if you clear those hurdles, you can get approved for a loan, but that's not going to solve the issue of you just winning a contract. And now you need to start covering those expenses that are going to start hitting your books very shortly. So I think for banks, it's just the fundamental nature of how they underwrite a particular credit. They're looking backwards. Fundamentally, they look in the rear view and try to get comfortable with that. What we're trying to do at ELINT and at Excalibur is we're looking at the contracts that have actually been awarded or are about to be awarded. So we'll look in the rear view, but we're also looking at the present and we're looking at the future. And that's, I think, where it's a bit unique and a little different. And here's the thing, as a former contracting officer, I'll say I know exactly what a federal contract means in terms of payment certainty and priority. I think most credit officers don't. They see a small business with thin equity and they pass. And it's not because the credit is bad, it's because they don't have the framework to evaluate it. I think banks are maybe getting a little bit better now. There's more options in the market today than there ever have been, but it's still a massive market gap, in my opinion. And that's why we're here.
And I just want to add to that too. The bank is also limited in the loan amount, that because they're basing it on your balance sheet and your credit score, as Eric said, and looking backwards, right? If you need $10 million to fulfill a contract and they're going to approve you for $500,000, you'll burn through that the first week, and then what? So what we do is our credit limit is moving dynamically with that contract. As you need the capital, we're providing that capital. If you win more contracts, that line of credit will increase with that contract backlog.
Great. Also, invoice factoring exists, lines of credit exist, SBA loans exist. What's wrong with those options for a government contractor specifically?
Yeah, I can take that. So I would say there isn't anything necessarily wrong with those. I think that it really comes down to the specific circumstances that someone finds themselves in, and then weighing the pros and cons of each. And so I think with factoring, generally the benefit is you don't necessarily have to provide 3 years of tax returns and go through that arduous process of getting underwritten like you would be if you went and applied at a traditional bank. So I think the barrier to getting capital is a little bit lower there. With factoring, though, I mean, it's important to understand what's fundamentally happening. You're selling your receivables at a discount, and you're doing that permanently. So most factors, they want simple AR. Government contracts, especially something like a cost plus or milestone based, they're not necessarily simple AR. And I think the mechanics and the costs can ultimately, like when you look at the pros and cons, I think for me, factoring is not cheap. And let's just take an example. If your discount factor is 10%, so you can get an advance of 90% from a typical factoring option. Well, it doesn't matter if you get paid on that invoice in 30 days or 30 months. And if you get paid in 30 days or 60 days, if you annualize the cost of that capital, because you're only getting 90% of that cash back, excuse me, you're only getting 90% of that cash back, that's a substantial cost. And so what we've strived to do here is we're balancing some of the speed that you get with factoring and the removal of those hurdles that you'd go through in the context of traditional bank financing, but you're also getting not exactly bank cost of capital, but it's generally more affordable than what you'll get with factoring. And so we're trying to thread that needle. But again, I don't want to make it sound like factoring is a bad option. I think it really depends on the circumstances. But for us, we think that the cost can often be a barrier to entry. And it can certainly have its place. I think there's a time and place for factoring. But for the clients that we work with, that's generally the common complaint. It's just quite expensive. And so again, that's part of what we've tried to address with how we've gone to the market with our with the XCon GovCapital partnership with ELINT. Excalibur, I'm sorry.
Okay, super. So what makes your financing different from anything else in the market?
Sure. Pardon me. So as we've said several times, and we'll say again, right? We underwrite the awarded contract backlog, not just past financials, not just current receivables. We're built for, and our product is built for the moment right after a contract wins work, which is when costs start immediately, but the payment can take 60, 90, or 120 days. For a growing company, that can be that where cash flow is tight, that gap is often the hardest thing to patch and is what hinders growth. So where traditional lenders usually look backwards, tax returns, balance sheet strength, credit profile, collateral, already issued invoices. Our focus is on the work that's already awarded and the cash that's needed to perform it. As Eric said, many contractors don't actually have a revenue problem. They have a timing problem. So the contract is real, the receivable is real, the government obligation to pay is real. The issue is that the cash doesn't arrive when they need it. So our product, and as Charlie said, and I want to stress this part, so our credit capacity moves with your contract backlog. So if you win a contract, if you have a backlog at $14 million and you win a $3 million contract, that will increase the capacity of your credit line with us. So if you win more work, that financing capacity grows with it instead of being stuck at a static limit. So we're designed around the government contracting reality, where payment cycles are often delayed, right? Milestone, cost-based billing, there's payroll pressure, subcontractor payments, and the risk that all cash flow problems can then become performance problems. So we're not just providing capital, we're aligning financing to contract execution, so contractors can stay focused on staffing, delivery, and growth.
Okay. So how does a contractor actually use this? When they win a new contract, what changes for them? And how does that affect what they can access?
Yeah, so when a contractor wins a new contract, their line will increase based on the capacity of the contract. The way they go ahead and use it is the same way you'd use Bill.com. You'd schedule a payment with your bank, or you'd make any online payment. During our closing process, we have a list of your vendors, we onboard them, and then when you want to make a payment, you log into our authenticated platform, you see the vendors that you provided us. If you need to add a vendor that's not currently there for whatever reason, there's a button, you click add vendor, you just add the information, and then you select the vendor you want to pay and how much you want to pay them. That's the gist of it.
I think an important thing here too is when I explain the product to people is it's from a financial model perspective, it works. It's not a credit card, but it works kind of like a credit card. It's like you have the money when you need it, right? Like every business wants a credit card, but the problem with credit cards is really high interest and low, low capacity, right? They have $30,000, but they can use it whenever they need to. And you could, in consumer credit, you can always call and say, hey, I need a credit line increase. And sometimes you'll get it based on your credit score or payment history. It works very similar to that. It's capital when you need it. Not having to sell your invoices, as both Josh and Eric talked about, and mobilization funding upfront. Like I said, 2 weeks in, you have your first payroll cycle. where's the money coming from? Well, you have this credit card essentially that you can use. And our payments work the same way. When a payment comes in from the government, you choose, just like a credit card, do you want to pay the minimum payment, which is the interest and the fees for that cycle, or do you want to carry a balance, or do you want some of the money back to pay down some of it? Identical to how a credit card works. And as Josh said, it's sort of the digital version of that. You pick the vendor you want to pay. We send the money to that vendor on your behalf.
I think the one other thing I will add is similar to a credit card as well. You might recall, and this happens both on business credit cards, but also personal, they will generally ask for your income levels every year. But if you want to request an increase in your line, they'll probably ask for it then to see, did your income go up? So, we make sure our numbers tie out and, the formulas they use support that increased line. And it's much in the same way that a credit card does that. We're doing something similar, where if you've won that contract, what changes is you're going to be able to borrow more, right? You're about to incur more expenses, but you're also getting more income, assuming that you've bid, appropriately and there's sufficient margins built in. So we will increase the facility if need be, as someone grows, as someone wins contracts.
Sounds pretty easy. I like it. So tell me more. What does qualification look like? What are you actually underwriting against?
Sure. So we have APIs in our platform that capture publicly available government data. So you give us your UEI, or we look it up, because that's publicly available as well. We pull your contract backlog, you verify those contracts, and you submit them. That's the heart of our underwriting process. We do want to know a little bit about your business. We want to understand ownership. We want to understand what it is you're doing. We care deeply about our customers and our relationship with our customers. We see ourselves as partners in growth. And that's what we're looking for with what we're underwriting. Eric, Charlie, do you want to add anything to that?
I think that was spot on. I don't have anything to add.
Great. So what size contractor is this platform designed for? Revenue, contract value, years in business? Give us the profile of your ideal borrower.
So there is no ideal profile. If you have government contracts, then that's the most important thing to us. We understand the importance of certifications. We understand the instability of everything that surrounds those right now. We also understand the importance of having long-term contracts when you have option periods that extend your current period of performance. There is no one size fits all to what we're looking for in a customer. It really is. We'll provide loans anywhere, upwards of $20 million and more. We can even do smaller loans on a more micro level under $1 million. So it really does run the gamut.
Okay, great. And set-asides, 8A, Hub Zone, service disabled, veteran-owned small business, women-owned small business. A lot of people in this audience have those certifications. Does that affect how you underwrite or what they can access?
Eric, you want to take
this one? Yeah, so we built the business specifically around the small business ecosystem, the set-aside ecosystem, and it's not an accident. So whether that's Hub Zone, 8A, SDVOSB, women-owned, these are our core borrowers. And I would say from a credit standpoint, an active set-aside can often be viewed as a competitive moat, notwithstanding some of the challenges that I think the 8A program might be going through right now. We still think it's a durable program. I think it's there by statute. And so that doesn't, having a set aside, in our opinion, and the other thing to add is there's more factors we look at than just the set aside status, but having a set aside isn't necessarily by itself enough information or inherently good or bad. I think it often is a good thing and allows you to go after more opportunities that might be sheltered from full and open competition. So that, I think, can be a competitive advantage. But we really love all of the small business programs that we work with, and frankly, it's a big part of what we do. And we have existing relationships, for example, with the HubZone Council. We did a webinar with them about a month ago. So that, this is a community that's not new to us. We know the program mechanics. We know the agencies that use these vehicles and set aside statuses heavily. We know the complexity. So yeah, we're big supporters.
Great. And how about, are there any situations where a contractor is growing too quickly for its existing capital structure?
I think all this happens all the time. I think this is one of the more common modes of failure with a lot of the existing traditional modes or forms of access to capital, whether that's traditional bank financing, fintech loans, SBA lending, you name it. I think that is a common challenge. I think the amount of conversations Josh and I have with a prospect who's telling us that they have an existing facility with an insert lender here that might be a factoring company, it might be a bank, and it's not working for them. I mean, this happens on a frequent basis, and so the challenge becomes, what do you do about it? Right? If that lender that you're working with can't provide the solution that you need to be able to successfully grow and perform on those contracts, then they're often scrambling, and it's usually reactive too. This stuff happens often in the midst of being awarded a contract. A company catches the car and now they're scrambling because they can't get the capital they need. And so this is really, really common, at least as far as what Josh and I encounter out in the marketplace.
And I think that's also, to add to that, it's the reason we exist, right? So it's like to help these businesses grow. And as Josh said, we view ourselves and our clients as partners. I mean, everyone, like I said, I'm the founder CEO. Every single client we work with has my cell phone number. If they want to text me, it's like, we want to give you the capital so you can grow. That's the entire basis of this. And if anyone's ever borrowed from a bank, sometimes, at least in my experience, it feels like they feel like they're doing you like a huge favor. and you have to, bend over backwards to get the money. And you're like, please, what do you need? And we try to avoid that as much as possible, because again, it's partnership that we're looking for to help our partners grow.
Great. And what disqualifies someone? If a contractor is listening right now, what would make you say no?
Not having any active government contracts, because the entire model is based on that. So that's an important part of it, is having active contracts. Other things that give us pause would be a pattern of negative CPARs. We'd be interested to learn more and understand what's going on there. And someone who's never done government contracting before would also give us pause. None of this means no. It just, we want to understand more to see if we're the right financial partner for you. Eric, Charlie, do you have any other comments there on that?
I think those are the big ones. I would add in, if there's active litigation with a contracting agency or maybe a contract is in active protest, something like that. But no, I think Josh, you nailed the big ones.
Great. And have you seen deals where the contractor didn't think that they would qualify and they did? What surprised you on those deals?
Surprised us, nothing. What surprised them, lots of things. Yeah, it happens all the time, and it's see the aha moment that our customers have when they understand our product is it's awesome. It's awesome for us. It's awesome for them because we designed this. It's designed by government contractors for government contractors. We understand the pain points of working with a financial partner, and we try to minimize those as much as we possibly can. And that ethos runs all the way through to the core of our product. It's why we consider the entirety of your contract backlog, because you're responsible for getting that work done and for paying it. You're going to be reimbursed. There's a schedule for that reimbursement. Got it. We understand. Bridging that gap is often the hardest thing, and that's one of the things that we're here for.
Great. And can your services be used alongside an existing line of credit, or does it actually replace it?
So more often than not, it typically replaces it. What I will say is there are cases where we can coexist with an already established credit facility. That's where you start getting into things like intercreditor agreements. So it really is case by case. But the overarching point I want to make here is we're very creative. We're eager to work to the points made earlier by Josh and by Charlie. We want to partner with our clients and truly operate in that capacity as business partners. We're willing to be creative about how we solve the problems that they're encountering. So it really just depends. I would say that if someone has an existing facility and it's working for them to some extent, maybe it's more permanent term debt and they don't want to get rid of that, that's okay. A really common example that comes up right now is a lot of clients have EIDL loans with the SBA. Well, the SBA generally will subordinate those loans to outside creditors. I don't want anyone to have to pay their EIDL loan off. Those are phenomenal terms that aren't going to likely come up anytime soon. 30 years to whatever the rates are. I think 3 or 2 something percent. So we can absolutely work with existing credit facilities. It just depends on the details.
Great. And we just want to remind everybody that today's presentation is being recorded. If you do have any questions, please type them into the question section of your control panel, and I will continue to read through those. Next question is this only available if you are a prime contractor?
No. So there are differences. I will be honest. There's differences in terms of how we underwrite and then how much we would be willing to lend if it's a prime contract versus a subcontract. But we can and do get comfortable with subcontractors. It's just going to come down to who are those prime contractors that the sub is working with, what's the nature of the work, to Josh's point, what's the past performance record. You might not have a CPARS record if you're doing a subcontract, but maybe you have other CPARS records on past prime contracts. So we'll want to look at and try to get comfortable with the performance record there. And we know too that some primes do grade their subs, and there sometimes is documentation available. But having a sub in and of itself or being primarily a subcontractor isn't some kind of automatic non-starter. We absolutely will work with those kinds of firms.
Great. How quickly can a contractor access capital after winning a contract?
Yeah, so we want to measure our speed to market in days, in weeks, not months and quarters. And so again, this is one of those cases where it depends how fast documents are getting turned in, how responsive is the customer to the questions that we need answers to, but we can move very fast. We're a non-bank lender. We don't have some of the regulatory burden that a bank has to go to. And so what that means, we're also very tech forward. Josh mentioned the platform we've built out. We're very proud and excited about that platform. We think that it's one of our key differentiators. So my point in all this is it really removes a lot of obstacles in terms of how fast we're able to move. So again, it's something we try to get done in less than a month, sometimes as fast as a couple of weeks. But of course, it depends on the details and the particulars for a given client.
Great.
Yeah,
And
just to add to that, Jennifer, if you don't mind, there's an end to that too, which is if you're an existing customer and you already have your facility with us, if that's already in place and you win a contract, that'll happen in a matter of a day or two. Once the key for us is verifying that the contract is authentic. That's what we use government information for to start, that we pull in. And then if sometimes that can be delayed, right? That can take anywhere, depending on the contracting officer and how quickly they enter the information into the system. It could take anywhere from a couple days to a couple months. In those instances where if there is a delay with the data itself, we just ask for verification from a signed copy of the actual contract. So yeah, we know that when you win a contract, that's the most critical time. So we do everything we can, and as Eric said, we're very tech forward. We look for every new thing that we can do that can be used to verify the information. We do.
Great. And I just wanted to, for anyone that's on the line that perhaps is new to federal contracting, we've mentioned the acronym CPARS. It stands for Contractor Performance Assessment Reporting System. This is what the government completes for the prime contractors. So just as an FYI on that, and we'll continue to go through the questions. So please feel free to use the control panel to type in your questions. Our next question reads, at what point should a contractor start thinking about contract-backed financing? Should they wait until cash flow actually becomes a problem?
No, I would say do not wait until it becomes a problem. I think that naturally that often turns into when they reach out. But in a perfect world, I think contractors, especially newer vendors in the marketplace, I think you need to start thinking about this as soon as you can. Even if it's not something you're going to get right away, I think educating yourself as to what the options are in the marketplace so that when the time comes to move, where you're going, who you're going to reach out to, and really just understanding the trade-offs and the pros and cons and all of those different considerations that come with the different ways you can access capital. They are certainly not equal. And as I mentioned earlier, it really depends on the specifics for each individual and what, just those circumstances are. But I think the sooner they act, the sooner they reach out, the sooner they educate themselves, the better position they will be in when it comes time to moving and actually doing something about getting a facility up and running, so you can focus on performance and focus on doing the best possible job for your client, for the government, that you possibly can.
Great. For someone listening right now with active federal contracts, what's the single most important thing that they should do to get ready to apply?
You can go to I'll jump in there. You can go to our website, is the first move, ELINTcapital.com. And there's actually a little empty box on that website. You can enter your UEI. You could do that right now while we're on this webinar. And we'll go into the government systems, pull your active contracts, and tell you in real time. Give it like 5 seconds. It'll tell you exactly the amount that you could potentially qualify for. And then, you could send us an email. We could also follow up with you. And then there's some documents that we'll need and get the process started. It's very, very simple.
Great. And where is ELINT Capital headed over the next 12 to 18 months? What's coming for the platform?
Josh.
Oh man, we are so excited about this. So the short is we're building ELINT into the system of record for contract-backed financing and contract execution, right? That means going deeper on underwriting, on servicing, on disbursements, and reconciliation across the life of a government contract. So we use automation around contract ingestion, contract verification, and underwriting already. We have deeper integrations on the way with different accounting systems, different banking systems, and other government data sources. So the goal of which is all going to be to automate compliance. That's the end goal of all this, and make this as seamless and light touch as possible for the contractor themselves. And which actually touches on another point that's unique about our product. We try to limit reporting as much as we possibly can. We use integrations into we use Plaid to gather information about your bank accounts, obviously read-only information. Shortly, coming up in the next few weeks, we have accounting integrations on the way. All of this we want to read your borrowing base reports and all that stuff that you typically have to put together. We want to read that as much as you want to put it together. So not at all. By leveraging technology, it's very easy for us to set up systems that and alerts, so we know what's going on and what we need to be aware of, so we can sleep soundly at night.
And to build on that, what Josh said, with all the integrations and technology, you're audit ready for the government in case that happens. So you have all of the paper trails of when you were paid, when the work was completed, what invoices were paid. All that is, as Josh said, it's digitally ready for you, which we found a lot of our customers love that feature. Actually, some of them more than the money itself, which is interesting. They say, I don't have to do reporting. That's fantastic. So yeah, that's something that we're pretty proud of.
Great. And if you look at the federal marketplace over the next 5 years, what do you think contractors need to prepare for now?
Eric.
Well, I think we're in a moment, and obviously every new administration, every new session of Congress has a fresh set of priorities and changes that they want to make to the federal acquisition system and framework. But I think it's fair to say right now we're in a bit of a state of upheaval. So of course, lots of uncertainty and some fear in terms of the direction of the market. One thing I think is important is that if you zoom out, the federal government, knock on wood, it's not going anywhere. The U.S. federal government remains the largest single buyer of goods and services on the planet. And are some of the FAR clauses and processes and procedures going to change? They are, but I think fundamentally, small businesses out there who operate in this market, they regardless of what changes, they're going to have to, as they always have, be ready to adapt, be ready to be competitive, make sure that they're managing their pipelines. It's all of the fundamental building blocks that makes any contractor successful. I know a lot's been said about the FAR overhaul, some of the executive orders. We're seeing some interesting trends come out of CSOs, the commercial solutions offerings, other transaction authorities, OTAs. At the end of the day, no matter what the mechanism is where the government is spending discretionary dollars on the goods and services that it needs, it's not going to fundamentally change how the vendor who's on the other end of that transaction has to think about performing and managing their P&L. So that's a very long-winded way of saying there's a lot of change coming, and I think it feels like we're in a state of upheaval, but at the same time, a lot of things are going to stay the same. The fundamentals that make someone successful, I don't think that's changing. The exact mechanisms as far as which vehicles they need to target and which agencies they pursue, those are all, I think, smaller and more tactical decisions that, of course, need to be made, and vendors need to make those choices for themselves. But a lot of what we're talking about over the course of the last hour, it's not really changing as a result of these broader market changes. And I think that's really important to remember. In spite of all of the things happening, I think these fundamentals, they're going to stay true for the foreseeable future. And by the way, the market isn't shrinking. The government is still going to continue to spend. And I think the contractors who treat capital structure and compliance as a competitive advantage and not just, something to figure out later when the problem arises, those are the vendors that are going to come out ahead. And that's what we want to help. We want to help those folks do that, and that's what we're going to help build.
Great. And where do people go to learn more or get started?
Again, our website's a perfect starting place. It's elintcapital.com. You can put your UEI in right away, see what you qualify for. And I think the question was asked earlier, what surprises people? I think that surprises people. They're like, they see that number, I can qualify for that, because again, it's not tied to your balance sheet or your credit score. It's tied to your potential contract that's been awarded.
Great. Okay, super. I think that's it for our questions. Any last remaining thoughts, Charlie, Josh, Eric?
I just want to say thank you, everyone, for being here, and thank you, Jennifer and Josh and Eric. And hopefully we'll meet some of you. I can't see anyone on this call, so I don't know who's here, but thanks again for being here.
Yeah, well said. Thank you, Jennifer. And for folks on the call, don't be a stranger. We're happy to just have a conversation, because every business is different. Sometimes you find the right fit. Sometimes it's us. Sometimes it's not. We're here to talk that through with you.
Eric, any last parting thoughts?
Charlie covered primarily what I was going to say. I did want to ask, did any questions come in, or we've seen those?
Yep, we covered those. Yeah, from the audience.
Okay, great. Wonderful.
Super.
I did want to say, Jennifer, I know we have follow-up webinars. We'll be here every 2 weeks. I don't know if it's going to be Josh, Eric, and I, but more information on compliance and things that ELINT Capital can do for anyone who's in the government contracting space.
Great. Yep.
So,
yes.
Yeah.
ELINT Capital will be with us every other Tuesday starting today. So thanks everybody for joining us, and we'll see you in 2 Tuesdays from today. Thank you.
Thank you.
Thank you.